Well, good morning, everyone. Welcome to BDO's Working in Australia webinar series, and happy welcome to the new financial year. But before we get too excited with FY24, there are a few matters that we need to clear up for FY23, and so today's session will run through some of the year-end employer obligations that we need to manage to close out financial year 2023. My name's James Trainor. I'm a partner in BDO's Sydney tax practice, and it's a pleasure to have you all on the session today. Just before I do the introductions, a few housekeeping matters. If you're struggling at all with the internet connection, you can just listen in audio mode. Just follow the prompts that are there. The slides that we go through today, they are located in the handout section. And they'll also be available to you via email at the end of the session. We'd love some questions as we go through. Please submit them on the question pane, and we will endeavour to get to these as the session runs through. But just with time, we may not be able to get to everything. So if there's something that we don't get to, we'll endeavour to follow up with you personally after the session. There's a link there if you're having any technical difficulties. Hopefully everyone is very familiar with the webinar now, so it hopefully will run smoothly. And finally, as I mentioned, after the session, we'll be sending through not only the slides, but also a link to the recording, so you can listen to it over and over again if that's what you'd like to do, and also the contact details for the presenters who are with you today. Now, those presenters who are with you today are up on the screen there, and it's my pleasure to have with me today, firstly, our special guest presenter, Mr. Andrew Hosken, who is branch manager at the State Revenue Office of Victoria, and we've had the pleasure of working with Andrew over many years, and we're really looking forward to his insights into the real sort of nitty-gritty of the issues that people face, what's happening in the Victoria State Revenue Office, but also more broadly as to what employers should be thinking about when they particularly complete their payroll tax annual reconciliations. Ben Watkinson, who's a director with me here in Sydney, will be leading that discussion with Andrew and covering off on payroll tax matters. And we're also thrilled to have Stefanie Merlino with us today, who's a partner in People Advisory, Global Expatriate Services and Employment Taxes based in BDO's Melbourne office. And Steph will run through some of the key changes that are coming around from this financial year, as well as some of the issues on single touch payroll. And finally, I'll go back and talk through some of the issues that employers need to consider when they're granting equity to employees as well. So that's our agenda, fairly packed agenda, but hopefully all of the matters we touched on today will be relevant for everyone. So without further ado, I'll hand over to Ben and to Andrew.
Thanks, James. As James mentioned this morning, we're very fortunate to be joined by Andrew Hosken from the Victorian State Revenue Office, and over the next sort of 15 to 20 minutes, we'll focus on some of the key tips and traps for employers for preparing your 2023 payroll tax reconciliation, as well as sort of touching on some of the current areas of focus of the various revenue authorities. So without further ado, I guess the first issue to sort of focus on, that is the interaction of medical practices and the treatment of the payments to doctors. This is actually really a hot topic in the payroll tax space and has been for the last couple of years. And we've obviously covered this off in previous sessions and publications, but following some recent cases, including the finalisation of the Thomas and Naz case in the New South Wales Court of Appeal, the position does appear settled. And what can be gleaned from these cases is that the approach taken from revenue authorities in capturing these types of typical administrative arrangements within the payroll tax net, and concluding that these contracts should actually be relevant contracts for payroll tax purposes. This is despite the fact that the contractor does simultaneously provide services to others, example patients, and the payments from the contractor is being sourced from funds that not have originally originated from the service entities. I guess putting all that simply, payments from a healthcare practice to their contracted practitioners may trigger payroll tax obligations with respect to those payments. The risk will actually come down to the individual arrangements and what is happening on the day-to-day practice of the clinic. So given all that, what does that mean from a payroll tax perspective? So Queensland were the first state to effectively put out something public on this particular issue, and they released a payroll tax ruling that effectively confirmed their position that these payments did fit within the relevant contractor provisions and were considered taxable wages from a payroll tax perspective. As you can appreciate, there was obviously some outcry with this particular release of the ruling, and subsequently Queensland have effectively gone on a bit of a backtrack and announced an amnesty for non-compliant medical practitioners. So this particular amnesty requires organisations to basically express their interest to participate in the scheme by the 29th of September this year, and basically additional requirements to be complied with by 30 June 2025, with payroll tax becoming payable on those payments from 1 July 2025. Interestingly, there are various limitations to the amnesty, and one of the quirks, or I guess, to the amnesty is that those organisations that were already treating their payments as subject to payroll tax and registered and paying payroll tax are actually not eligible for participation in the amnesty. So effectively, the amnesty is really only applying to those organisations that were not currently paying payroll tax, and provides those organisations an opportunity over the next few years to get ready to effectively treat those wages as taxable. If we move to the next slide, South Australia have also come on board with an amnesty just in the last few days as a result of their state budget. Similar requirement to register by 30 September 2023 there, but the close-off date for the amnesty in South Australia is 30 June 2024, so 1 year earlier than Queensland. South Australia have also released a public ruling, and there's a payroll tax circular out on this particular issue, so plenty of material there covering SA Revenue's approach to this particular topic. Maybe, Andrew, if we can kind of maybe just now turn to the Victorian position on this, I guess, as it's obviously a hot topic, I was hoping you could, potentially share Victoria's position on this issue. Is there plans for, a similar amnesty in Victoria? And, is this, a specific area of focus of the Victorian Revenue Office at the moment?
Yeah, thanks, Ben. So I guess first of all, the important thing to start off with is that the Victorian SRO position on these types of payments hasn't changed. So historically, we've treated those payments where relevant as relevant contract payments, and that continues to be the position of the Victorian SRO. To a degree, complicated a little bit by Queensland going a bit rogue just before Christmas and issuing their ruling, and further complicated, I guess, by the South Australian issue as well, which really for employers makes things quite difficult in a I guess a disharmonised harmonisation payroll tax arena. So really, I guess the simple thing is, from a Victorian perspective, we haven't changed. Are there plans for an amnesty? At this point, there's not. There's certainly plenty of discussion within our office and also in conjunction with the other revenue officers. I am aware that representations have been made by peak bodies, predominantly the AMA, to government in terms of the Victorian office following the steps taken by Queensland and now SA. But I guess The tricky bit with the Queensland position, Ben, is that whole issue about it only applying to, let's call them those practices, I guess, that aren't already paying tax on those payments. So, you know, to me, there's a little bit of an equity issue there with the Queensland position, and I suspect that, you know, if we were to embark upon an amnesty, we'd be looking to do something that is potentially more equitable than the way that one looks to me at the moment. My advice to employers that are in this particular industry would really be to seek expert guidance on the way their contracts are structured. I mean, this is an issue that really revolves around the way that contracts between the practitioners and the service entities are structured. And the best advice that I could give would be to have employers or practices seek guidance from people like BDO or other advisors. You're most welcome to contact SRO as well, to get a bit of advice and guidance in terms of what the obligation is likely to be. Because, as I say, contracts do vary from practice to practice, but my issue really would be, don't just ignore it because it's not going to go away. Are we specifically targeting industry employers in the medical industry? No, we're not. We have a couple of compliance matters on hand at the moment that I'm aware of, but we're not specifically targeting this industry. We never have, and that continues to be our position. Certainly, there's a little bit more awareness at the moment about payroll tax and medical practices, but at this point in time, it's certainly not our intention to specifically target medical practices for compliance activity.
Thanks, Andrew. That's great and really, I think, valuable insights for the audience on that particular issue. So I think if we now turn to some of the sort of current areas of revenue focus, and we're definitely noticing, I think, an increased sharing of information between government authorities. I know myself personally, you know, I've seen just in the last few weeks a couple of you know, reviews in respect of the treatment of fringe benefits tax from a payroll tax perspective, which obviously, you know, comes from the sharing of information between, you know, the ATO and state revenue officers in respect of FBT. We're seeing, obviously, you know, sharing of information between, you know, ASIC and revenue officers in particular around, you know, structures and, you know, how that can potentially, you know, give rise to grouping issues. I guess the sort of other areas of focus that I've sort of seen are, you know, those particular payments that don't go through payroll and are not immediately obvious that might be subject to payroll tax. So your things like, you know, employee share schemes, contractors, directors' fees. But interested in sort of hearing your sort of thoughts on or insights into, you know, the current areas of focus from your perspective, from a payroll tax perspective, and I guess indeed how, you know, revenue officers use data sharing in their compliance activities.
Yeah, sure. So certainly something that revenue authorities have become a whole lot better at. You know, when I first started in the revenue office many years ago, the ability to share information was limited and pretty much didn't happen. One of the things that does happen now on a very regular occurrence is, in fact, the revenue officers getting together and collaborating to a degree on targeting, but most specifically in terms of sharing outcomes from compliance activities. So really what you will likely find is that if the Victorian SRO does an investigation and finds a payroll tax issue, it's likely that the outcomes from that review will be shared with other revenue officers where that employer employs in other states. So straight away, the other revenue office has a bit of an insight into what's happening at that particular employer, and it's likely that at some point in time a review will be triggered. Certainly, there's a bit of work happening where the revenue officers will actually conduct reviews or audits on behalf of other revenue officers. I've certainly seen some involvement of those where, for example, in multinational arrangements where the Victorian Revenue Office, for example, will take the lead on a particular matter, and finalise the outcome on behalf of all of the revenue officers. I mean, a bit of a benefit to the employer in that space is that there's one review rather than particularly 5 or 6. But certainly the sharing of information is significant. But timely, the FBT stuff, Ben, you know, we get regular downloads from the ATO of FBT data, sorry. And as I'm sure you can imagine, it's pretty simple for us to make some judgments against FBT amounts disclosed on payroll tax returns against FBT amounts disclosed to the ATO. And I guess in that space, one of the things that I would really encourage your clients to do when they're completing their year-end return, which is not that far away, is to include FBT in the FBT field on the annual return. Because if you don't, then, and you've lodged an FBT return, you're setting yourself up as a pretty easy target for us to come and knock on your door, or send you an email at least to say, well, you know, you've got an FBT liability, but you're showing us a 0. So a simple, really a simple fix, I think, to help overcome some of that sort of stuff. You're right about ASIC. You know, we're forever getting data from ASIC. We use that data, as you suggested, to help us identify payroll tax groups. We use the data to work through shareholders. We use the data to work through directorships and those sorts of things. So really key data in that space. And it continues to surprise us, the number of groups that we find still through that data matching process. You know, it's incredible the number of success, what we would call a successful audit. A successful audit is where there's either an amount payable or a refund payable arising from simple data matching from ASIC. So, you know, again, my advice in that space is, you know, if people have multiple entities, to get really good advice to make sure that they're treating their payroll tax payments correctly, because the loss of a payroll tax threshold can be a significant arrears amount when you retrospectively assess 4 years plus add a little bit of penalties for the hell of it. So really advisable to get some decent advice where there are multiple entities that are employing. You know, James is going to talk about employee share schemes a little bit later, but again, as you say, a really obvious area where payments don't go through payroll. And you know, we certainly recognise that one of the real difficulties that employers have in managing their payroll tax affairs is that payroll tax doesn't just necessarily sit with payroll. You know, that doesn't necessarily sit with HR. There are a whole range of parts of the businesses where bits and pieces need to be fed through. And so sometimes a review of process can be the right thing to do to enable employers to sit back and be comfortable that they've got their processes all sorted out. So, you know, the sharing of data is huge. It's significant. I mean, we have a specific area in the Vic SRO staff. There are 15 or so specialist staff. They're data miners, they're data scientists, they're actuaries, and what they do is they mine through all of this data looking for targets. And at the moment, the success, as I said before, is somebody owes us money or we owe them money. In terms of data matching audits, is about higher than 99%. So, you know, the good thing for employers is that, you know, if everything's okay, chances are you're not going to be audited. But also the converse of that is that if you are contacted, chances are that there is something that we know that's led to that and it's likely to result in an outcome.
Thanks, Andrew. I think that's really useful information and great for you to be able to share your experience there. So if we move on to the potential pre-filling of payroll tax returns coming out of single touch payroll. So obviously this was sort of an initial announcement that was sort of flagged when STP 2.0 first came in, around one of the sort of potential benefits for employers. I mean, that, you know, they would only obviously you know, need to look at the data once, and it effectively would flow through and save time and admin for employees in complete being able to effectively have their payroll tax returns pre-filled with the STP data. I know there's sort of been a pilot in this space going on, and that's concluded. interested to sort of hear from you, Andrew, of sort of the status of that, where that's at from Victorian revenue perspective, and yeah, the next steps in that regard, and whether we can sort of see any developments in that space.
Yeah, look, I was hoping to chat with our representative on that board, but she's been off sick for the last couple of weeks. So, my update is going to be a little bit out of date in that regard, Ben. I mean, issues obviously with pre-filling is a bit challenging. Certainly addresses where people live, don't necessarily get updated in HR systems, and hence, the ATO doesn't really care where you live in Australia, whereas payroll tax, the revenue officers certainly do. So there's a whole range of even simple issues like that really don't make it easy for this to be a simple transition across from STP lodgements into the pre-filling of payroll tax returns. Add into that, obviously, the obligations that don't go through payroll and don't go through STP. Are we expecting too much of something that perhaps wasn't designed to initially to pre-fill payroll tax returns? I suspect that that's the outcome. But look, what I'll do is I'll undertake to have a conversation with Ingrid. She's due back next week, and I'll feed some feedback back through you if you like, and then you can pass that on to your clients.
That would be great. That would be great.
Yeah, cool.
Thanks, Matt.
No worries.
So I think what we just wanted to sort of cover off now, and I'll sort of let Andrew sort of go through these next couple of slides, but there was obviously some significant payroll tax changes in the recently announced Victorian budget, around the COVID-19 surcharge and some other changes. So Andrew, are you able to sort of take everyone through those sort of key changes?
Yeah, let's start at the good stuff first, hey? So let's go to point 4. So the payroll tax threshold is increasing from the 1st of July 2024 to $900,000 from $700,000, and then up to $1 million from 2025. So I'm tipping for most employers not a great win, but a win nonetheless. So let's take the good and then offset that with some of the stuff that I'm about to talk about. So the COVID-19 temporary payroll tax surcharge is the official title of the surcharge. We found out about the surcharge obviously a couple of days before the state budget was handed down early May. It's an additional surcharge charged at the same rates as the current Victorian mental health and wellbeing surcharge, and applies from the 1st of July of this year, which means that employers will have the surcharge calculated in their first monthly return, which will be due and lodged by the 7th of August 2023. Now, prior to this meeting, I was in a board meeting where we were talking about this particular surcharge and some of the other upcoming payroll tax issues. So what's going to happen here is that there have been some amendments made to the monthly return structure. At this point in time, it is likely that the calculation of the mental health surcharge and the COVID-19 temporary payroll tax surcharge will be amalgamated into one calculation. Our IT group has just not been able to work at such that those items will be different. I mean, effectively, if you wanted to split out the mental health surcharge from the COVID-19 surcharge, it would simply be a matter of dividing the total by 2, given that they're both going to be exactly the same. We do recognise that there will be some confusion around that, and so there'll be some comms come out from us, certainly to all payroll tax employers that are currently paying the mental health and wellbeing surcharge. So that's employers with wages over $10 million. There'll be some comms come out from us towards the end of this month. So we drafted some information that we're going to send after the closure of this year's annual return. So the annual return closes on the 21st. So we were talking this morning about probably sending out a bit of an update around the 27th or 28th of July, just so that we don't confuse people about closing off this financial year and what you've got to do from the next. So look, it's not complex. The system will calculate the payments, Ben, but ideally we would have been able to show employers the MHS and the COVID-19 temporary, but that's not going to be the case. Our IT group is saying to us from the 1st of July 2024, that's how it will work. But they've just not had the time for that to happen. And the second point there is right, that the temporary surcharge is a surcharge that's in place for 10 years. So really, it's about the government trying to recoup, I guess, some of the monies that were handed out as COVID relief along over the last few years. The private schools exemption. So historically, not-for-profit private schools have enjoyed a payroll tax exemption in Victoria and in most other states. The government has decided to remove that exemption in part, and to impose a payroll tax obligation on private schools with annual tuition fees in excess of $15,000. So that limits it to about 60 schools in Victoria. And there is some information available on our website. There's a link to a Victorian Government gazettal notice that provides details of the excluded schools. But again, an exemption that will be lost from the 1st of July 2024. So something for us to be mindful of now, and potentially for any private schools that are involved in this call to seek advice on how they should be starting to work their way through at least making provision for payroll tax in Victoria from the 1st of July 2024, but not an urgent issue for 2023. And that's kind of it from a payroll tax perspective, from a budget point anyway. So
yeah, great. I think that's enough for one budget from a payroll tax perspective.
I think so.
But I think just the last thing we wanted to sort of cover briefly is just sort of any tips or traps, I guess, that you would have for employers for, coming up to do their annual reconciliation. That, as we said, it's due in a couple of weeks. So if you can sort of, any comments on that,
sure.
would be great.
Yeah, so the process is electronic. Obviously, it runs through our Payroll Tax Express system, lodged and paid. Important, lodged and paid, underlined, bold, italics, and all of that sort of stuff by the 21st of July 2023, which is Friday, a few weeks away. The 2023 annual return does only include the mental health surcharge. The COVID-19 temporary surcharge only applies for the financial year ended 30 June 2024. Important when you're going through the annual return to check the monthly payments that have been made. Not uncommon for us to lose a payment or to misallocate a payment. And so there's a facility within the annual return for you to correct our errors in that space. So important for you to do that. But like I said before, Ben, when we were sort of chatting about FBT and the data matching stuff, as painful as it is, it's important for employers to break down their payroll tax obligations into each of the fields that are shown on the return. And the reason that I say that is, it doesn't change the bottom line, but what it does change is the potential that you might get a request for an FBT audit when it really isn't relevant. So showing data, accurate data in the fields is good practice in my mind to, I guess, with the knowledge of our data matching capabilities, to hopefully avoid the imposition of us, starting an audit without necessary reason. And I guess my final point for the annual return, and as silly and simple as this might sound, is to remember to hit submit. So the very last thing that happens with the annual return is there's a little button at the bottom and it says submit. We get many employers, more than 10% of employers will go through the process of, I won't say completing the annual return, but of populating the annual return, and they fail to complete it because they don't hit submit. So please remember to hit submit. So of the most technical of advice that I can provide, hit submit.
Thanks, Andrew. That's excellent. I guess practical advice for employers. So I think that covers everything that we sort of wanted to cover from the Revenue Office insight. So at this point in time, I'll hand over to Steph for some single touch payroll updates.
Thank you, Ben, and thank you, Andrew. That was a really insightful session. It's always really valuable getting insights directly from the Revenue Office. What was most interesting to me was the fact that 99% of targeted auditing leads to an increase or a reduction in payroll tax. So I guess it's highlighting the importance of ensuring you're comfortable with your payroll tax compliance. Before I begin, I do just want to apologise. I've had a bit of a scratchy throat today and a coughing fit right before my session, so I'll be sipping away at my warm water if I need. Hopefully I can suppress my coughing and won't need to hand over to Ben or James. But my session, I'll be covering off on single touch payroll for a few minutes. So to begin with, STP Phase 2 reporting commenced on 1 January 2022. Now, because Phase 2 of STP required changes in software and some software updates, it did mean that many employers and payroll providers obtained deferrals for up to 12 months and in some cases more. And I know there's still, to this date, some organisations who have not yet implemented Phase 2. The ATO did honour no penalties for genuine mistakes for the first year of reporting. So that was 1 January to 31 December 2022, just to ensure that employers help them to ease into that additional reporting. So what is STP Phase 2? So single touch payroll, it's the real-time reporting of an employer's pay and superannuation data. With Phase 2, it's more granularity of that reporting. So you can see I've got a bit of an extract there of some different categories. Initially, most payments were just allocated into gross, whereas under Phase 2, payments are now allocated across, it's around 36 different STP types or pay types. So it gives the ATO more transparency across the particular payments that you are making to your employees and can ensure the ATO has oversight over this data and can then target any potential compliance activity. At the end of the day, they want to ensure that you're paying your employees correctly, the right codes are being mapped for superannuation, etc. In terms of obligations, so the STP end of year finalisation declaration is due by the 14th of July. There is the ability to apply to the ATO for a deferral if that date is not possible. Where you're paying under STP or using STP, there's no need to issue payment summaries or to lodge a payment summary annual report. An employee will get their year-end data through their MyCub account through their income statements. The exception, of course, is if you're making payments outside of STP, then you will need to issue a payment summary for those particular payments. So the takeaways from here, have you reviewed your payroll configuration? Are you comfortable now that we're 18 months into the mandatory reporting date, subject to any deferrals? Are you comfortable that your pay codes have been mapped correctly and that the information you're sharing with the ATO is correct and a true reflection of the payments that are being made? So that's STP label mapping. What about your pay codes from a pay-as-you-go withholding perspective and a superannuation perspective? And as I mentioned, we do anticipate now that we're into the journey of STP Phase 2 that we will start to see some ATO compliance activity in this space. Now, my next update, I'll be providing some significant changes from 1 July 2023 and beyond. So there's a few things I'll be highlighting, some updates, but also a couple of cases. So there's some superannuation updates on this slide. I'll follow with some FBT and then some state budget updates as well. I know that Andrew and Ben touched on that earlier as well. From a superannuation perspective, so superannuation, the rate has increased to 11% from 1 July 2023. You're probably aware there's been a number of increases in recent years, and we'll continue to see 2 more 0.5% increases until we reach a 12% SG rate from 1 July 2025. So the impact on your super obligations, this will depend on whether you pay your employees base plus super or a total employment cost. So if you're paying your employees base plus super, this increased super rate will mean you're going to have a higher superannuation contribution being made to an employee. So it's going to cost you more, all things being equal. However, if you pay your employees a total employment cost or you've got an annual remuneration package that you offer your employees, the impact of this SG increase will mean an employee's gross pay will reduce, all things being equal, with a corresponding increase in their superannuation contribution being made. So they will feel an impact if their pay or their total remuneration isn't increasing from 1 July 2023 as a result of this increased super. So we're seeing a lot of organisations, they're choosing to increase an employee's package or remuneration by the amount of the super increase to ensure an employee doesn't feel worse off. And it's really important nowadays, particularly given we've got a high inflationary environment, high interest rates, and the overall ever-increasing cost of living. So whilst there will be a benefit to employees by increased super, that total employment cost, I know it's a decision a lot of employers are choosing to make to ensure that employees feel no worse off. Some other changes for 2023-24, the maximum quarterly contributions cap has increased to $62,270. What that means for your higher income earners who have ordinary time earnings in excess of that amount, your super contributions can be capped at 11% of that 62,270 in order to comply with your SG obligations. And I've set out on the slide that corresponds to $6,849.70 of super contributions per quarter. The interesting thing there, given we've seen an increase in the SG rate, an increase in the quarterly contributions cap, but not an increase in the concessional contributions cap, for higher income earners, just by an employer making those contributions of 11% capped at that maximum quarterly contributions cap, annual contributions are almost equal to $27,500, so it's about $100 off. So I would be very surprised or if these higher income earners make any additional salary sacrifice super, as those additional contributions will likely result in the concessional contributions cap being exceeded. So something to be aware of there. If we move on to the next slide, FBT. So this slide, I wanted to cover off on an update following passing of legislation. It's the simplification of FBT record keeping requirements legislation. It's received royal assent a couple of weeks ago. So FBT, for those of you involved in the FBT preparation process, no doubt you would agree that the FBT process is a very administratively burdensome one. Often the administrative effort that goes into preparing your FBT returns far outweighs the resulting FBT payable that you're calculating. What this measure is designed to do is to simplify the record keeping requirements. To give context, there are around 20 employee declarations and elections that must be considered by an employer when they're completing their FBT return. So if we think about the otherwise deductible rule, that's a declaration that you need to get from your employees where you're seeking to reduce the taxable value of certain benefits. Often it can be many emails and follow-ups to an employee to get that declaration. And in the absence of getting a signed declaration before filing of a return, you can't actually technically apply that concession, which means a higher FBT payable. So it's a very administrative burdensome process. And as a result of this legislation receiving royal assent a couple of weeks ago, the Commissioner of Taxation now has the power to allow companies to reduce their FBT compliance costs by utilising other corporate tax records. So there may be the ability to rely on other documentation instead of that administrative burdensome process of having to get declarations and elections from all of your employees. So we will see a legislative instrument being issued by the Commissioner, which sets out the alternative documents and records that can be relied upon. However, employers may still choose to use improved forms such as employee declarations if they wish. So that's a very welcome change. The next update I have from an FBT perspective, it's actually a case. It's a decision that was handed down a couple of weeks ago in relation to fly-in, fly-out arrangements and the FBT implications of travel expenses. So this case, it's For those employers who offer FIFO arrangements, I thought it was worth sharing because it really highlights some of the principles that were set in the John Holland case a few years ago. So in this case, Bechtel had applied the otherwise deductible rule to travel expenses. They had quite a few employees who would travel to Curtis Island that required travel from a point of origin airport. They would then fly to Brisbane Airport. From there, they'd fly from Brisbane Airport to, I think it was Gladstone Airport, and then catch a ferry to Curtis Island. So you can appreciate a significant amount of time spent travelling and significant travel expenses incurred by Bechtel to enable employees to arrive at the destination at which they were performing their employment. Across a time period of around 8 FBT years, there was circa $13 million of FBT in dispute that related to these travel expenses. Now, the taxpayer was of the view the otherwise deductible rule should apply. The Commissioner disagreed. Bechtel had relied on the John Holland case. And at this case, I mean, the key principle that was set out was that an employee's shift commenced on arrival at the Metropolitan Airport or the point of hire, and as a result, their travel expenses were considered a business expense. Now, in this case, unfortunately, that argument did not succeed on the basis that employees were not rostered on to duty as soon as they arrived at their point of origin airport. So as a result, their travel did not relate to travel between two places of employment. Instead, they were seen to commence their employment at Curtis Island. And as a result, FBT applied to that full amount of travel expenses. So a very significant liability for the employer, and a real focus on ensuring that you prepare, or employment contracts specifically state when an employee commences their work, or what's their point of hire. Are they being paid to travel, or are they being paid from the point at which they arrive at the site at which they're meant to perform their duties? So something to be aware of if you have FIFO arrangements. Moving on to payroll tax updates. So I know we had an update from Andrew and from Ben from a Victorian state budget perspective. Thought it would be worth covering off on other jurisdictions. And as a general theme, so we didn't see too many states introduce any additional payroll tax measures. We have not yet seen New South Wales issue their budget. That's to be handed down in September. But generally, most jurisdictions had a higher than budgeted payroll tax revenue during the 2023 financial year due to strong labour market conditions. And I mean, that's a reflection of the fact we've got very low unemployment at the moment. Victoria, unfortunately, was the exception, and Andrew and Ben touched on some of the measures that were introduced in Victoria. So Victoria has a large focus on increasing taxes for those with an ability to pay, and it was the budget really was a strong response to address Victoria's significant debt, and that was the case both from a payroll tax and a land tax perspective as well. So on the next two slides, I have just set out at a very high level some of the measures that were announced from a payroll tax perspective. I won't go through Victoria's in detail, given Andrew and Ben have touched on that, but it was the COVID debt levy and the other items that were on the slide. In Queensland, however, Queensland also had some measures that were introduced, but that the positive news there was really more an extension of some concessions that were available. For example, the first up point is an extension of the payroll tax discount for regional employers. So that's been extended until 30 June 2030. There was also an extension to the apprentice and trainee payroll tax rebate. So that's been extended for another 12 months. The payroll tax amnesty, now this was announced before the Queensland budget, but that was also something that has been honoured by Queensland, noting, and I take on board some of the points made by Andrew. The other thing to note, so Queensland state government has had some additional funding. The funding is to be used over the next 4 years for tax compliance work, debt recovery and compliance measures. So the likelihood is we'll start to see some more targeted auditing coming out of Queensland. I know Victoria is doing a lot. That was a really interesting update. So probably going to see the other jurisdictions follow, which is demonstrated by this additional funding announced in the budget. Thank you, James. That wraps up my update.
Thanks very much, Steph. That was a lot to get through in a short period of time, so thank you for summarising that so well for us. The last topic that we're going to cover today is employee share schemes. And again, like has been spoken about before, this presents a little bit of a challenge for employers at year end because not a lot of this information is finding its way into mainstream systems. So not through the payroll system, yet you have to report it for payroll tax purposes and also to the ATO. So this involves just a little bit of attention to detail to make sure that employers who are offering shares and options to their employees actually get their reporting right to the ATO, because it is information that will go through to pre-filled tax returns. And so employees are relying on employers to get the right information through. So what are the reporting obligations for employers? Well, firstly, there are two things. To the employee, there's a requirement to provide an employee share scheme statement. This needs to be given to employees relatively soon, so the 14th of July. And it's a statement that provides details to the employee of the shares or options that they've either received during the year or that may have a deferred taxing point. And we'll go through some of those concepts in the following slides. A couple of important things to note with that statement for both the employee share scheme statement as well as the employer reporting is that these are obligations on the employer, and that might be different to the company that's actually issuing the equity. And so a classic example is you might have a foreign parent that is issuing the equity, but the obligation falls onto the Australian employer. So they need to get information to be able to do that. And whilst I refer to it as an employee share scheme statement, that reporting obligation does extend not just to employees, but also to equity awards that have been made to associates of employees, to directors, and also to sole trader contractors. So it's a bit of a broader definition. As I mentioned, as well as reporting to the employee, there's an obligation to report to the ATO. And this is an employee share scheme report that needs to be provided by the 14th of August to the ATO. And there are a couple of ways that employers can do this. Firstly, it can be done through the ATO portal. And that's just a manual input line by line for each employee. So a little bit time consuming, and it's also capped at 50 employees and 3 different types of schemes. So what we find is that many employers use a third-party software solution to prepare not only the ESS report for the ATO, but also the statement for the employee. So what I'm going to do in the next couple of slides is run through some of the reporting obligations, but looking at it from the point of view of different types of awards. So the first group are awards of shares to employees. And importantly here, when we look at the first two, the $1,000 tax exempt shares and ESS startup concession shares, is that potentially there's no tax liability for the employee, yet there's still an obligation on the employer to provide this information to both the employee and the ATO. So for the $1,000 tax exempt shares, there's a reporting obligation at the time of grant. And the amount that needs to be reported is the discount. So essentially the market value of the shares that are provided to employees. And in most cases, this is going to be just under or around about $1,000. When we're looking at ESS startup concessions, so these are certain startup companies that satisfy conditions to be eligible to provide concessionally taxed shares and options to their employees. Again, these need to be reported at the time of grant. Nothing's accessible to the employee, but it's information that the ATO will tuck away and will use then to make sure that down the track, the employee is reporting the right amount of income when eventually those shares are sold. So at the time of grant, there's an obligation to report the number of shares, the market value of those shares, what the price was at the time of acquisition, and the date that those shares were acquired. There's also an obligation at the time of grant to report taxed upfront schemes. So these are schemes that might not be broadly available or where there's no risk of forfeiture. And in both of those cases, then there's an obligation for the employer to report the discount, being the market value of the shares, less anything the employee pays, at the time of grant. The final share scheme award that I'm going to touch on are tax deferred schemes. So this is a case where there might be a scheme that's broadly available to staff, and either there's a real risk of forfeiture so there are some vesting conditions, or potentially it's a salary sacrifice arrangement. So there's certain schemes that allow you to sacrifice up to $5,000 worth of what would otherwise be salary and receive shares instead. And so if you satisfy these conditions, then rather than being taxed at grant, those shares are taxed at a deferred taxing point. And that's when the reporting obligation arises for the employer. So it's important to know what the type of scheme is to determine when the amount is that, or when you should be reporting, and also the amount to report. So for these schemes, generally the deferred taxing point is the earliest of when there's no real risk of forfeiture, and the scheme no longer genuinely restricts disposal of those shares. But it can be earlier, and the maximum deferral period is 15 years from the grant date. So we rarely see plans going longer than 15 years, but it's important to note that you could have a taxing point even if the shares haven't vested yet. The other point to note with the tax deferred scheme is the 30-day rule. And what this rule is to say that, well, look, if the shares are disposed of within 30 days of the deferred taxing point, then the taxing point and all the reporting moves to the date of disposal rather than what would otherwise have been the deferred taxing point. So classic case, the shares vest, there's no risk of forfeiture, employee can sell those shares, and they do so, say within 15 days after that taxing or that deferred taxing point. In that case, all of the reporting happens on the day of actual disposal. So you look to the value of the shares at the day of disposal and report on that amount at that point in time. The other group of awards that I'm going to touch on are rights awards. So these are typically things like stock options or performance rights. And again, there can be reporting at the time of grant. And again, it can be reporting where there is no assessable amount for the employee. So we touched on the ESS startup concession when we talked about shares. Under the ESS startup concession, employers can also provide options to their employees. And these options do need to be reported at the time of grant. And there's a requirement to report the number of options, what the market value of the underlying shares was at the time of grant, the exercise price, and the grant date. And so all of that information needs to be provided to both the employee as well as the ATO. And again, the ATO will use that information to make sure that down the track, employees are reporting the right amount of income when eventually the shares are sold from the exercise of those options. We also have some tax upfront schemes. So potentially you could grant stock options to employees, and those options have no restrictions on them. So they could immediately be sold, transferred, exercised by the employee. And in that instance, those options would be taxed at the time of grant. And if that's the case, and then there's an obligation to report those options at the time of grant, and you're reporting the discount. So what the market value of the options are. And the tax rules and the regulations supporting those rules provide some valuation tables to assist employers to determine what's the amount that should be reported, what that discount is. Similarly to what we spoke about with share awards, if you're granting rights to employees, it's also possible to have a tax deferred scheme. So particularly where we're talking about options, it's quite common that tax is deferred because the scheme has some sort of restriction on it. So the employee is not immediately able to exercise their options, or there's a disposal restriction on the share that might be acquired from exercising those options. And if you have those eligible features, then a tax is not arising at the time of grant, but it's actually arising at a later time at the deferred taxing point. And that could be when there's no risk of forfeiting the right, or if there is a disposal restriction on the right at the time it is granted, and this would be the most common scenario, when that right is exercised and there's no further restrictions on the share which is acquired from exercising the right. Again, like with shares, there's a 15-year cap on the amount of time that the taxation can be deferred. So again, it's possible that you have a taxing point arising before the employee actually exercises their rights. But 15 years is a pretty long time, so we don't often see that arising in practice. At the deferred taxing point, again, there's an obligation on the employer to report the discount, and typically that's going to be the market value of the shares less the exercise price, but it can be a different amount if the tax liabilities arising in relation to an option. Again, you might have to rely on some valuation tables to determine the market value of the option. And like we spoke about with shares, there's also the 30-day rule. So if an employee exercises a right and that would otherwise be the time that is the deferred taxing point, and they sell the resulting share within 30 days, then it's the disposal of the share which is the taxing point, and reporting arises at that point in time. So important, I guess, point to note is that the particularities of the scheme and the timing of when things happen is really important for employers to get across to make sure that they're reporting at the right time. Just a couple of points, tips or traps just employers should be aware of when it comes to reporting. So with expatriates, we're starting to see employees start to move around the globe again. That employers have the ability to choose to report either the full discount, or if the employee was only in Australia for part of the period, employers can report only a portion of the gain based on time in Australia. And the key thing there is that you've got the necessary data to do that apportionment and then do the correct reporting. And it's really important that you communicate that information out to the employees. And that might involve a little bit more than what's actually on the ESS statement and some sort of separate communication so employees understand what the number is that it's appearing on that statement. Indeterminate rights are a subset or a particular type of employee share type of award. And these awards at the time of grant, you might not know whether the employee is going to get shares or cash, or indeed the number of shares or rights that they're going to be entitled to receive. And so in many instances, employers won't be able to do any reporting at the time of grant because they don't know what's going to happen. If we roll forward and these awards are settled in cash, then that's just a payroll item. So it runs through payroll, there's PAYG withholding, single touch payroll reporting, and superannuation obligations arise in respect of that cash payment. Alternatively, if the employee ends up with shares, then we are into ESS reporting. So it's important again for employers to be mindful of what's actually happened with their awards, what did the employee actually receive, and then do an assessment at the time they receive the shares to determine actually, should they have been reported at the time of grant because perhaps they didn't satisfy any of the conditions for deferral. So there's a little bit of work that needs to be done by employers. Finally, something that's a bit rare, but just important to note that if employees don't quote their tax file number, then when there's a deferred taxing point, employers need to deduct TFN withholding at the top marginal rate. And this also needs to be reported to both the ATO as well as on the employee share scheme statement. I touched on this previously. There are a couple of ways employers can report to the ATO. There's the ATO portal, so employees can go into the portal, enter the information there themselves, or otherwise use compatible software. And typically the software will prepare both the ESS statement and the ESS report. And the helpful thing around that is that if you're using someone like a tax agent, they can help you understand what your obligations are as you kind of go through each of the different types of awards and look at trying to determine when's the right time to report and what's the right amount to report. So there is some assistance out there if you're struggling to understand the obligations. Finally, just to tie things back to payroll tax, just because it's a little bit tricky and people are managing their payroll tax obligations or their annual reconciliations at the moment, that payroll tax and income tax don't always align. And so the key point there is that the taxing point for income tax, that being the deferred taxing point, may be different to the point in time when payroll tax is payable. And so it's not always straight alignment. And I think this sort of draws out some of the challenges that Andrew was referring to when, the state revenue officers are perhaps looking to rely on federal government information to determine a payroll tax liability on a state base when the rules don't quite align. And in most states and territories, employers can choose to declare the employee share scheme income either at the date of grant or at the vesting date. And the vesting date is specifically defined in payroll tax legislation. And for shares, it's generally when any conditions attached to the shares have been met and the employee's rights and entitlements to those shares can't be rescinded, or for rights, it's when those rights are exercised. And in both cases, it's maximum 7 years from the grant date. So not the 15 years that's available under the income tax rules. So again, important to look at your shares and rights and determine, not just for income tax, but also for payroll tax, when's the right time to report them. Also for payroll tax, some slight differences. So the amount that's included for wages for payroll tax purposes might be different to the income tax discount that you're reporting to the employee. And one example of that is that for the employee share scheme startup concession that I was talking about before, when you're valuing the awards under the income tax rules, there are concessional valuation methodologies. These aren't applicable when you're talking about payroll tax. So you might have a slightly different amount. So again, just some quirks to make it what seems to be relatively straightforward, a little bit quirky and a little bit confusing. So really just important to make sure you understand your plans and your obligations and seek professional advice where that's required. So that takes me over the timeframes that we had. I appreciate we've run a couple minutes late. With that in mind, I think we'll probably hold over any questions. I think we had a lot of stuff that was covered by Ben with Andrew. And so I'd just like to take this opportunity particularly to thank Andrew Hosken for joining us today and providing the insights. It's always really valuable, Andrew, to get those insights as to what's happening in the revenue offices, and obviously what you're seeing in Victoria can play out across the other states and territories. So employers should heed those awards to hit submit, even in New South Wales and Western Australia. So I really appreciate your insights, Andrew, and the time that you've taken today to share with us. And hopefully you get back to watching a little bit of sport and fill your walls with some other great material. So thanks for your time. And also thanks to Ben and to Steph for your time today. Steph, we got through without any coughing fits, so that was really good. Your insights into the changes that's happening in the year ahead and what employers need to plan for the year ahead, again, are really, really valuable. So thanks very much to both of you. Well, with all of that, thank you everyone who attended the session today. As I mentioned, the recording will be available, the slides will be available, and we look forward to hosting you again sometime in the coming months, where we have a look at some more obligations or some more issues that affect employers in Australia, and hopefully we can come up with some more relevant topics. So if there's something that you're interested, by all means, sort of feed that through to anyone who's on the session today. We'd love to get some information and provide some more sessions that are valuable and covering issues that are relevant to you. So thanks very much, and enjoy the rest of your day, everyone.